$50,000. That's not small money. That's a number most people spend years working toward. And when it finally shows up, whether from a bonus, an inheritance, selling something, or just disciplined saving, the pressure of not screwing it up is real. Here's the uncomfortable truth. Doing nothing with it is still a decision. Inflation runs at 3 to 4% a year. A savings account earning less than that is technically losing purchasing power every single month. So the clock is already ticking. But here's the good news. $50,000 invested smartly, even with average returns, has the potential to become hundreds of thousands of dollars. And with strong returns and enough time, it can cross $1 million. This video is going to show exactly how to get there, step by step. Before investing, get the foundation right. Before a single dollar goes into any investment, there are two things that need to be handled first. Skipping these steps is one of the most common and most costly mistakes people make. Step 1. Build an emergency fund. An emergency fund is 3 to 6 months of living expenses sitting in a high-yield savings account. Liquid, accessible, and completely separate from investments. If monthly expenses run around $3,500, that means keeping somewhere between $10,500 and $21,000 set aside and untouched. Without that cushion, the first unexpected expense, a medical bill, a job loss, a car breakdown, forces a withdrawal from investments at exactly the wrong time. That could mean selling stocks during a dip, paying early withdrawal penalties on a retirement account, or making a desperate financial decision under pressure. Any of those outcomes chips away at long-term wealth. High-yield savings accounts are currently offering 4 to 5% APY in many places. So the emergency fund isn't just sitting idle, it's quietly earning while staying safe and accessible. Step 2. Pay off high-cost debt first. If credit card debt is charging 20 to 25% interest annually, paying that off is essentially a guaranteed 20 to 25% return, completely risk-free. No investment in the world offers that with zero risk. If debt is costing more per year than the stock market typically returns, around 10%, pay it off before investing. That's true for high-interest credit cards and personal loans especially. Now, not all debt is the same. Lower-cost debt, like student loans or a mortgage, especially if there's a tax deduction attached, doesn't need to be fully cleared before starting to invest. The priority is eliminating the high-cost stuff first. Once the emergency fund is solid and the high-interest debt is gone, everything else in this video applies to what's left. Step 1. Start immediately. The single most powerful factor in building wealth isn't picking the right stock. It isn't timing the market. It's time itself. The longer money stays invested, the harder it works. Compounding, where returns generate their own returns, is the closest thing to a financial superpower that exists. And every year of delay is a year of compounding that can never be recovered, starting with $50,000 and not adding another dollar. And at 10% annual returns, which is roughly the historical average of the S&P 500 over long periods, after 30 years, $872,000. After 35 years, $1.4 million. After 40 years, $2.26 million. Now look at what an extra 5 years of patience is worth. Going from 30 years to 35 years at 10% returns adds roughly $532,000 in total gains. 5 more years, $500,000 more dollars. That's why starting immediately matters more than almost any other decision. Not next month, not after the next paycheck, now. Because time in the market is the variable that compounds everything else. Step 2. Get clear on the investing goal. Not all $50,000 should be invested the same way, because the why behind investing should determine the how. There are 3 main categories of investing goals, and each one calls for a different approach. Goal 1. A specific near-term target. If the money is earmarked for something specific, a house down payment, a business start, a major life event, and it's needed within the next 3 to 5 years, then safety matters more than growth. The stock market can drop 30 to 40% in a bad year. If that money is needed soon, a market crash at the wrong moment is catastrophic. For near-term goals, the focus should be on lower risk vehicles, high yield savings accounts, CDs, short-term bond funds, or treasury bills. These won't generate explosive returns, but they'll protect the principal and ensure the money's there when it's needed. Goal 2, long-term overall wealth. If the goal is simply to grow wealth over time with no specific end date in mind, a standard brokerage account is the right tool. These accounts allow investing in stocks, index funds, and ETFs, assets with the best long-term growth potential. Gains compound over time. Taxes on capital gains are deferred until the investment is sold, and the money remains accessible if needed. This is the most flexible approach. Goal 3, retirement wealth. If the primary goal is building retirement security, then specialized tax advantage accounts are the most powerful option, and they come with benefits that a standard brokerage account simply can't match. The goal comes first. Once the destination is clear, the right vehicle becomes obvious. Step 3. Choose how to invest. Once the goal is defined, the next decision is who's actually going to manage the money. There are 3 real options. Option 1. Manage it personally. This sounds intimidating, but it doesn't have to be complicated. The research consistently shows that passive, buy and hold investing in low-cost index funds outperforms most professional money managers over the long run. Choosing a few well-diversified funds and leaving them alone is genuinely one of the most effective strategies available. It requires minimal time and virtually no expertise once it's set up. Option 2. Use a robo-advisor. A robo-advisor is an automated platform that builds and manages an investment portfolio based on goals, timeline, and risk tolerance. It handles rebalancing, diversification, and ongoing management automatically. The cost is typically very low, often around $25 per year for every $10,000 invested. For someone who wants professional-grade portfolio management without the professional price tag, this is a strong option. Option 3. Work with a human financial advisor. A financial advisor can provide personalized guidance, especially for more complex situations. Tax planning, estate considerations, business structures. The key is finding one who is a fiduciary, meaning they're legally required to act in the client's best interest. Fee-only advisors are generally preferable to commission-based ones, since commission-based advisors have incentives that don't always align with the client. Any of these 3 approaches can work. The right one depends on how much time and involvement feels comfortable. But the investment principles that generate real wealth over time are the same regardless of who's doing the managing. Step 4. Invest the money. This is where most people get overwhelmed, and where most people make mistakes. They try to pick winners, they chase trends, they move money around based on headlines. Over 90% of active fund managers underperform their benchmark index over the long run. These are professionals with teams of analysts, sophisticated tools, and decades of experience, and they still can't consistently beat the market. So if the pros can't do it, the smart move is to stop trying and just buy the market. The S&P 500 index fund is the cornerstone of most serious long-term investment strategies. It tracks the 500 largest publicly traded US companies: Apple, Microsoft, Amazon, Google, and hundreds more. It's broadly diversified, has historically returned around 10% annually over long periods, and comes with extremely low fees. For even broader diversification, a global index fund spreads exposure across international markets as well, betting on the growth of the global economy, not just the US. Where to hold these investments matters just as much as what to hold. A standard taxable brokerage account is the most flexible option. No contribution limits, no withdrawal restrictions, money accessible at any time. Capital gains taxes apply when investments are sold, but long-term capital gains rates are lower than ordinary income tax rates. Another reason to hold investments for the long term rather than trade frequently. The ideal structure for most people with $50,000 to invest: emergency fund, fully funded first. Max out the Roth IRA, $7,000 per year. Contribute enough to the 401k to capture any employer match. remaining funds into a low-cost S&P 500 or global index fund in a brokerage account. Reinvest all dividends. Don't touch it. Let compounding run. With a lump sum of $50,000, one of the smartest approaches is dollar cost averaging, spreading the investment out over several months rather than putting it all in at once. By investing a fixed amount regularly, the risk of buying at a market peak is reduced. Some months, stocks will be cheaper, some months, more expensive, but the average purchase price smooths out over time. It removes the anxiety of trying to time anything and makes the process automatic. Building real wealth from $50,000 isn't complicated. It just requires doing the right things in the right order, and then staying the course. Get the foundation right first, emergency fund in place, high interest debt cleared. Then start investing immediately, because time is the most valuable asset of all. Get clear on the goal. Pick the right account structure. Put the money into low-cost index funds. Keep adding. Reinvest everything, and that's the playbook. It's not exciting. There's no secret, but it's the approach that has turned ordinary incomes into extraordinary outcomes for millions of people. And $50,000 is more than enough to get started on that path. Start now, stay consistent, let time do the heavy lifting.